All right, welcome future CPAs. If you're a Gen Z accountancy student gearing up for the Philippine LECPA in a couple of years, you are in the exact right place. In today's explainer, we're totally mastering Tax Quiz 3, Exclusions from Gross Income. And look, we're not just going to sit here and read the tax code to you. That's boring, right? Instead, we're using a proven study hack called cognitive chunking. Basically, we're going to wire your brain to retain these rules not just for your quiz tomorrow, but for your board exams 3 years down the line. Let's get into it.
So let's be real for a second. Reading the tax code, it literally feels like trying to drink from a fire hose. How on earth do you actually lock all this information into your long-term memory? Well, the secret is organization. If your brain doesn't have a specific labeled folder for a piece of information, it just drops it. So today, we are building memory vaults. We're taking this massive, intimidating list of tax-exempt receipts and categorizing them into a highly logical, totally unforgettable blueprint to essentially hack your brain for the exam.
Okay. Here is your ultimate LECPA study blueprint. We are splitting these exclusions into 6 distinct memory vaults. 1. Core concepts. 2. Section 32B and gifts. 3. Sickness and damages. 4. Retirement and separation. 5. Gov benefits. And finally, 6. Statutory rules. Take a mental screenshot right now, and let's start moving through them.
Vault number 1, core concepts, the foundation. We have to start here because understanding the why behind the tax code is absolutely the first step to locking in the what.
Okay, let's dive right into this vital distinction. In taxation, exclusions and deductions are entirely different beasts. Exclusions are untaxed receipts. They're income or a flow of wealth where the law basically says, nope, we aren't even going to look at this. They never ever enter your gross income computation. Deductions, on the other hand, are expenses that you subtract way later to reduce your taxable base. So just remember, exclusions are taken out of the game before the game even begins.
Moving on to vault number 2, Section 32B, Life Events and Gifts. These are the untaxed receipts tied to major life events and gratuitous transfers, stuff given to you for free.
Let's look at a classic board exam trap regarding life insurance. The principal proceeds paid to heirs upon the death of the insured are fully exempt. Why? Well, because the law treats this as an indemnity for a life lost, right? It's not a profit. But here's the catch they love to test you on. If the insurance company holds on to those proceeds and pays you interest on them, that interest is totally taxable. The principal is just replacing a loss, but the interest? That's new wealth flowing in.
All right, let's do a rapid-fire bullet review for gratuitous transfers. When you receive property as a gift, a bequest, or a devise, the value of that property is excluded from your gross income. The reason? Because it's subject to transfer taxes instead, like donors or estate tax. But watch out for this second trap. Say your uncle gifts you an apartment building. The building itself is exempt from income tax, but the rental income you generate from that building the very next month, you guessed it, fully taxable.
Vault number 3. Sickness, injury, and damages. This vault is super logical and focuses entirely on how the tax code treats compensation for physical harm.
And this brilliantly illustrates what we call the make-whole doctrine. If you get into an accident and receive damages for a broken leg, or say you win a lawsuit for libel, defamation, or slander, those compensatory damages are totally exempt. The BIR knows you aren't richer. You're literally just being made whole again. However, if you sue someone because they breached a contract and you lost business profits, those recovered profits are fully taxable. Because think about it, if the breach hadn't happened, you would have paid tax on those profits anyway.
Let's burn this study hack list into your visual memory. For personal injuries and sickness, the BIR excludes accident and health insurance recoveries, workman's compensation, actual damages for injuries, and get this, even the moral and exemplary damages attached to those suits. Just remind yourself these payments are meant to heal you, not to generate a profit.
All right, vault number 4, retirement and separation benefits. Pay really close attention here, guys, because this area is highly tested on the LECPA, since it involves specific numbers and strict conditions.
If an employer has a BIR-approved private pension plan, the retirement benefits are exempt, but, and this is a big but, only if you meet the 10-50-1 rule. You've got to lock this one into your brain. First, you must have served that same employer for at least 10 years. Second, you must be at least 50 years old. And third, you can only avail of this exemption once in your lifetime. Miss even one of these 3 steps, and that retirement money gets taxed.
Now, what if you leave the company before retiring? For this, we look at control. If the separation is involuntary, meaning it is completely beyond the employee's control, like death, sickness, physical disability, retrenchment, or redundancy, the severance pay is totally exempt from income tax. But if you voluntarily file a letter of resignation just because, you want to change jobs, that separation pay is fully taxable. Control is the absolute key here.
So let's see how this builds if the company doesn't actually have a BIR-approved plan. The law steps in with Republic Act 7641. This alternate rule requires the employee to be between 60 and 65 years old, and they must have served at least 5 years in the same establishment. You have to actively differentiate this 65 rule from the 50-10 rule we just talked about. Don't mix them up on exam day for sure.
Vault number 5, Gov Benefits and Contributions. This chunk deals with your everyday paycheck deductions and government safety nets.
So, the crucial point we need to make here is about the legal minimum. When you get your paycheck, your mandatory contributions to SSS, GSIS, PhilHealth, Pag-IBIG, and your mandatory labor union dues are all excludable from your gross income. But listen closely to this. The BIR only excludes the legal minimums, not a single peso more. If you decide to voluntarily contribute excess amounts to your SSS or Pag-IBIG, those voluntary excess contributions are not excludable. They are fully taxable.
Quickly synthesizing a few more high-yield points for your exam. Benefits you actually receive from SSS and GSIS, including government retirement gratuities, are exempt. Allowances for government personnel, specifically RATA and PARA, are also exempt. And if you happen to have clients receiving U.S. Veterans Administration benefits while residing in the Philippines, those are excluded too. These are just quick, easy points to grab on the test.
And here we are, our final memory vault. Number 6, Special Statutory Exclusions. These are the miscellaneous, highly specific rules created by special laws.
90,000 pesos. I want you to burn this massive number into your retinas. Under the tax code, the gross benefits received by officials and employees as 13th month pay and other benefits like your productivity bonuses and Christmas bonuses are strictly excluded from taxable income up to a ceiling of exactly 90,000 pesos. Anything, and I mean anything above that amount, automatically becomes taxable compensation.
Now, what's really interesting here is how the BIR views winning. Our prize is taxable. Usually, yes. But if a prize is primarily in recognition of a civic, religious, scientific, or educational achievement, think something major like the Nobel Prize or the Ramon Magsaysay Award, it's exempt. The strict conditions are you must be selected without any action on your part to enter, and you aren't required to render future services. So, winning the lotto or a TV game show, generally taxable or subject to a final tax. Winning a Nobel Prize, totally exempt.
Just to lock in the final pieces of the Philippine setup puzzle, keep in mind these specific entity exemptions. Barangay Micro Business Enterprises, or BMBEs, registered under RA 9178, are completely exempt from regular income tax. The exact same goes for registered cooperatives. When you see these entities pop up in a CPA problem, remember they have a special statutory shield.
Okay, we've officially built all your memory vaults, so let's test them with a real brain burner. If your client is retrenched and gets 100,000 pesos severance, plus they get back 100,000 pesos in voluntary excess SSS contributions, which chunk is taxable? Think about it for a second. Retrenchment is involuntary, so the severance is exempt, but voluntary excess SSS contributions, those exceed the mandatory limit, so that chunk is taxable. Do you see how the vaults work together? Review your notes, trust your chunking, and you are absolutely going to crush the LECPA. Keep studying smart, guys.